Hey, investor. Ready to uncover the secrets of masters Warren Buffett and Charlie Munger? They reveal powerful strategies for investing even with modest amounts. Let's unravel how Buffett would pick his stocks with little cash and why Munger points to hidden opportunities. This duo means business, so if you want to uncover the tricks the big players use, stay tuned until the end. And of course, if you enjoy the conversation, don't forget to subscribe to the channel to catch the next hot tips. Let's dive in. 5. Buffett's Investment Strategy. So when it comes to investing, it's amazing to see how even Warren Buffett, this master of billion-dollar investments, started small like us. He advocates that, even dealing with modest amounts, the key strategy is the same one he uses to move billions. His approach is to go after top-notch companies available at fair prices, always keeping an eye on long-term growth potential. It's interesting to note that, in Buffett's view, cash flow is like the heart of the business. He always asks how much money a business can generate compared to the price we pay for it. In reality, the focus is on evaluating whether the business is really worth the investment, considering the return it can provide over time. It's a bit like buying a money-making machine. Another cool insight is that he thinks dealing with small amounts has its advantages. When you have less money to invest, the field of opportunities is broader. The logic is to allocate a larger percentage of your money to smaller companies that are growing rapidly. He emphasizes that, back when he had less money, he could invest in 1 or 2 companies that would bring absurd returns. Because let's face it, finding a business that will explode is easier when you're not dealing with billions. So look, if we follow Buffett's idea of applying the same strategy even with small amounts, the secret is to look for high-quality companies, keep an eye on cash flow, take advantage of the flexibility of small amounts to explore broader opportunities, and of course, look for those under-the-radar companies with high growth potential. It's worth paying attention to these details when investing, right? 4. The importance of cash flow. Man, one thing that Buffett always emphasizes is the importance of cash flow in investments. He never tires of saying that it is the true heart of the business. Think about it. He highlights that we need to look at how much money a business can bring back compared to what we pay for it. It's like we're doing a kind of cost-benefit analysis, but in the world of investments. The thing is, Buffett insists that we have to evaluate if the investment is really worthwhile, got it? He places an absurd emphasis on looking forward, focusing on the returns that future cash flow will bring. It's like betting on the business's future. He always asks, how much is this business going to give me back in cash in the future? The logic behind this is to think about the business's appreciation itself. If the cash flow is solid and promises to grow, the investment becomes more interesting. In practice, he wants us to focus on the business's potential to generate profit over time. It's like investing in the company's own financial future. So, buddy, in short, Buffett's message is clear. When investing, don't forget to take a good look at this thing called cash flow. It's like the compass that will guide our decisions, you know? Keep an eye on the future and the returns that will fill our pockets. 3. Advantage of small amounts. You know, a brilliant insight that Buffett shares is about the advantage of dealing with small amounts of money in investments. He says it kind of opens the doors to the universe of opportunities because, let's face it, when you have less money, the field becomes broader. And that's where the magic comes in, investing in smaller companies that are making that quick growth leap. The reality is that when you have fewer zeros in your account, there's more freedom for allocating your money. Buffett emphasizes that this gives you the chance to put a larger percentage of your portfolio into smaller companies that are scaling up quickly. You know what that means? Potential for astronomical returns, my friend. The thing is, back in the day when Master Buffett was starting and wasn't swimming in money, he had a blast investing in 1 or 2 companies that exploded and brought in absurd profits. Because let's face it, it's easier to find a gem when you're not dealing with mountains of money. The moral of the story is that if you're starting and the money is tight, it might be a chance to find hidden pearls in the ocean of opportunities. In summary, Buffett's play is clear. Take advantage of having less money to explore the world of small companies with growth potential. It's like having a treasure map in your hands, you know? So if the money is tight, don't get discouraged because the opportunities are out there, ready to be discovered. 2. Ease of composition with small sums. You know, Buffett talks about how composing small amounts of money is like navigating calmer waters than when you're dealing with mountains of cash. He makes this comparison quite real, like Imagine the challenge of increasing a company's profits from 1 million to 10 million. Now think about the work it would take to increase from 100 billion to 1 trillion. It's a whole different level. What the master emphasizes is the agility that small companies have in this race. Listen, he almost compares it as if it were a 100-meter sprint versus a marathon. Small companies at the start are already lighter and faster, while the giants are there with a weight on their backs, trying to catch up. It's kind of a flexibility thing, you know? In practice, Buffett wants to convey the idea that when you're dealing with a more modest amount of money, it's easier to see that small company triple, quadruple its profits. Now try to do that when the company is already in the billions. It's like comparing accelerating a remote control car with a cruise ship. And honestly, it's more enjoyable to see the zeros multiply when things are more agile and less gargantuan. So, my buddy, Buffett's message is clear. If you're dealing with a more modest sum, the ease of composition is greater. It's like having more freedom and flexibility to chase the returns you want. After all, it's easier to pull off radical maneuvers when the boat is smaller, right? The tip here is to leverage this agility to your advantage. 1. Search for less-known opportunities. Man, Charlie Munger drops a tip that's like a ninja secret of investments. Check it out. He says that when you're operating with a small amount of money, the deal is to go after stocks that are somewhat in the shadows, outside the radar, hidden. He calls these beauties obscure stocks, like those that few people know about, that aren't in the public eye. The deal is this. People tend to drool over stocks like Microsoft, Apple, those that are always in the spotlight. But Munger gives a cool tip. He says it's worth digging into lesser-known stocks, those that are more in the shadows. Why? Because these stocks often are undervalued by the market, meaning they're being sold for a song. The insight is that when no one is looking, you can find real hidden gems, understand? These are the opportunities that, because they're not on people's radar, have the potential to bring super expressive returns. It's kind of like finding a lost treasure, a gold mine that most people don't even notice. So if you're looking for something different, out of the ordinary, these obscure stocks might be the path to results beyond the conventional. Think about it, my buddy. The market is full of hidden surprises. Those stocks in the shadows can be the key to incredible returns. So pay attention to Munger's advice. Look for these less publicized opportunities because sometimes it's in them that the true growth potential resides. It's like exploring an unknown territory in search of the next success, you get it? It's in this hide-and-seek game of the market that we can find the real jewels. So, folks, we've reached the end of this dive into the world of investments with Warren Buffett and Charlie Munger. If you enjoyed uncovering the secrets behind their strategies, don't forget to leave a like to strengthen the community. Oh, and if you're not subscribed yet, let's join our community because there's a lot more high-octane content coming your way. I want to know in the comments, which insight surprised you the most? Tell us! Thanks, dedicated investors, and see you in the next video. Strong hug!